Okay, well, thanks everyone for joining today. I'm Mike Young. I cover Ontario here at PenderFund. With me today is Geoff Castle. He is the portfolio manager for our flagship bond fund, the Pender Corporate Bond Fund, as well as our investment grade option, the Pender Bond Universe Fund. On the line as well is Alex Toth. He is joining us from our Vancouver office. He'll be helping run the presentation today. So we have a great presentation lined up. This should be a great introduction to our fixed income mandates here at Pender, and really just great insight overall as to how Geoff and his team run the funds, and just to look at some of the opportunities that they are seeing in today's credit markets. The presentation should last about 40 minutes. After which we'll do a quick Q&A session. Now, if you do have questions, feel free to type those in as we go along during the presentation, and we'll get those answered at the end, or just wait until the end during the Q&A session, and we will get those answered then. So with that being said, let's get started, and I will hand it over to you, Geoff.
Thanks a lot, Alex. And if I'm successful, hopefully a little bit less than 40 minutes on the direct presentation. I'd like to give anyone a chance to ask questions. Let's start with, I'm just making sure I've got the, okay, here we are. So let's start with just a bit of background on me. How am I different than the typical cat that may run a bond fund? Well, I've been around a fair number of years in the investment management business, so that is some experience. The difference is really between myself and other managers. I would kind of put sort of three ways. First of all, a fair amount of corporate experience. So post MBA, I did do a tour of duty or 4 years at Bain & Company, the strategic consulting firm, really sort of inside the company, working for large North American companies on significant issues. So for instance, I worked on getting Shoppers Drug Mart ready to sell when Amasco wanted to sell. We did some M&A work with London Life after they were acquired by Great West Life in terms of what pieces to keep and what to sell. And then also more laterally, when I was returned to Vancouver, I spent a few years as a member of the board of directors of a fairly stressed copper producer. So essentially a fair amount of context for doing due diligence, that you've not just been on one side of the screen with red and green lights, but you've been inside the company, inside issuers, and understand really the challenges and the issues that the company faces. The sort of second difference would be potentially as a result, really a kind of fundamental focus. So, we're not just relying on rating agencies to tell us what's good credit or not. We do whole company valuation, a strategic assessment of where those issuers sit, and then let that dictate essentially our view on how well covered the credit securities are. And then the third difference is really, particularly with the perspective of evaluating the riskiness of various securities, quite a data-driven approach to credit investing. There's kind of one school of thought, which is to look at a long series of bonds that are rated similarly and just pick the one with a higher yield. But there actually, over the years, have been other methods developed. And so as we assess relative risk in the portfolio, we use things like default probability models, which have been developed over time, which have the advantage of changing every day, and are not typically the rating system tends to be somewhat outdated. The rating agencies will update a rating something like once every 3 years, when the risk in the company will change every day. And then, in addition to kind of our approach on ratings, we also use that kind of default probability to rebalance positions within the portfolio according to their risk. So that's a bit of background on me. Just talk about the team as a whole, and sort of what are the resources which are working for you on this fund. So obviously there's myself and Pearl Garg and Emily Wheeler, two very strong credit analysts who work with me. Outside of that, if you guys are not that familiar with Pender, we have a great, group of equity analysts on the other side. And for those of you unfamiliar with Dave Barr, he's a very strong full balance sheet thinker, as are many other of his analysts on that team. And so, beyond the work that we do, obviously we have some help from the rest of the team. Importantly, and I'd like to think of one of the advantages that our fund has is the ability to turn over more rocks. We look at a lot of different securities. And one of the things that helps us to do this is a couple of relationships that we have with buy-side focused credit research shops that work for us, or a phone call away. They have other clients in sort of New York hedge funds and so forth, but we have the ability to access really over 95 analysts, and they tend to be sector specific, and they tend to have quite long histories. So you'll see us do, if you're a client of the fund, you'll see us do some different things. Where we might be involved in a technology name or a biotech name, or might be involved in Puerto Rico bonds or something of that nature. And you think, oh, how do a few people from Vancouver know about all these different areas? Well, often we're going hand in hand. In the case of Puerto Rico, beside the credit sites, municipal bond analysts who've been doing distressed municipal credit, for 20 years, and so that really helps us, turn over more rocks. Outside of that, these are the tidbits. Outside the donuts are the execution counterparties we have. I think at this point we have something like 25 execution counterparties. I tend not to rely on those parties for research because they tend to want to tell you whatever they think you need to hear to be the other side of their trade for the much larger New York-based client. But you need them for execution, and you need them to get good prices. So, what's our game plan? How do we run the fund? And to take a step back, the game plan is really designed from the point of view of our end client. And you think of our end client, the typical holder of a bond fund in Canada, someone roughly 70 years old. If you're 70 years old, how old were you in 1985? Well, you were probably something like 34, 33, and you are, you have a visceral memory of just taking your paycheck, going into the bank, and having a checking account or a savings account that gave you 8 or 9% interest. And now you these days you're retired and you go to your advisor, and they're talking about 1 point something percent. And so there's with that client there's a kind of a frustration with the level of income that's available. On the other hand, the other part of this client's personality is that they're a fixed income client, and they're constitutionally incapable of accepting a drawdown. And so you have to have a very, very strong defense game in order to protect that client from volatility and be able to deliver that person the returns over a long run. They need to be able to stay with you all the time. So there's a big defense game. So what does that look like in practice? Well, let's talk about the defense first. So obviously in equity investing, and you guys are familiar with the concept of margin of safety. Well, the same thing for credit investing. So there's one way to look at investing in bonds. You look at a list of bonds, and one is you see one bond yielding 5% and one bond yielding 3%, and you kind of go 5%, 3%. Well, I like the 5%, and distressingly often that works, but when it doesn't work, it really doesn't work. And there is another way, and that is to forget for a second that the company issues any securities whatsoever. And let's just value the company as liquidated. If I had to take this company, and sell all its assets and all the business units and collapse all the working capital, what do I have? And then I take that liquidation value and I compare it in descending order of liquidation preference to all the debt securities the company issues. And where I have more than 2 times coverage on that basis, to the level of bond I'm looking at, well, now we can talk about 3% or 5% because I have some confidence that my principal is protected. So that's one key part of the due diligence process. The second is actually inside the company due diligence. So we do work. We call the company. We are do that sort of scuttlebutt type research. We have our various analysts outside the company that we will refer to. And it's not just that we do the due diligence, but having the experience we do, we have more capacity to kind of interpret than someone whose entire career has been on one side of a screen with red and green lights. The third thing we do on the sort of risk management side is relates to sort of portfolio and position limits. So I always think of the first job we do for our client is not necessarily to make money for the client. The first job we do is if our advisor needs to get the money back, if our advisor wants his money back, we have to pay them. And that implies a certain modus operandus because, credit markets are not always fully liquid. So we have a portion of the fund, never less than 25%, and right now it's around 45%, which is what I consider to be, same-day liquidity, high quality, most liquid, which would be things like, investment-grade bonds, government bonds, or if they're high-yield bonds, they're bonds with very, very little, credit risk and very large issue size that trade like water. Technically speaking, bonds with a one-year default probability of 25 basis points or less. And then so we take that portion of the fund. Then there's a second bucket in the fund, which I consider to be two-day liquidity, which is more or less your run-of-the-mill high-yield bond. Obviously, we think they're better than run-of-the-mill. We like the risk-reward in those bonds. And between half of bucket 2 and all of bucket 1, that's all the time got to be able to deliver more than 50% cash in any particular day. And then there's a third bucket, which is we call sort of special opportunities, which is areas where we can make a bit of money, but we limit our weighting in that bucket to never more than 25% of the fund. I think right now it's around 15% of the fund. And then the second thing we do from a kind of a position limits is, we have sort of maximum sizes depending on what tier of the fund that holdings are in. So, no matter how smart you are, no matter how good your due diligence is, there are always going to be things that come along and surprise you. And you want to be able to avoid catastrophic risk. And one of the ways we do that is by having a maximum position size. So no more than 5% of the fund in any issuer in the least risky category, no more than 4% in the middle category, and no more than 3% of cost in any position in that highest risk category. I've been in this business quite a long time. I've seen guys blow up funds. I can tell you the formula for that. It's first of all, you have to be really wrong about something, and then you have to buy it like there's no tomorrow as it goes down. And then you need to find out that you were wrong after everybody else has, and suddenly you get in big trouble. So, you can't always protect against being wrong. So that's the third point. The fourth point on kind of risk management is this whole idea of monitoring real-time risk signals. So, essentially, we look at every issuer in the fund from the point of view of default probability. And, default probability models have evolved over time. Back in the 1970s, the Altman Z-score became, popular. And then after 2008, there was a lot of work on these sort of Merton-based models, which were, the main one that runs off of Bloomberg was created by a guy who left Lehman Brothers after 2008. Lehman Brothers on the 14th of September 2008 was an A-rated credit. And on the 15th of September, it was bankrupt. And, last year, a few people got 6 cents on the dollar back in some Lehman bonds. Is there a better way than the rating system? For sure. And so, default probability models take into account all the objective things that you can know about a credit. So what the market cap is, how much debt there is, what the cash flow from operations is, what the term structure of the debt is, what the volatility of the related equity, and a few other factors. And they all go into, sort of an algorithm, and out pops a 1, 3, and 5 year default probability. And if you compare the predictiveness of the default probability model against what the rating agencies do, particularly once the rating agencies have a kind of stale rating, is actually much more predictive and has the advantage of being real time, so it changes every day. And so once a week, we sit down with a full team, we look at all the positions in the fund, and what you'll find is that the default probability will change, and sometimes that'll cause us to either elevate from a lower bucket to a higher bucket, or sometimes relegate from a higher bucket to a lower bucket, and that will actually require us to maybe do some changes, or to change position sizes, or maybe to eliminate positions. So we're on top of that on a kind of real time basis. So that's sort of the defense game. The offense game, we obviously want to generate some returns, and one of the advantages we believe we have is we look at more securities. I think if you take a look at the typical Canadian high yield fund, you're going to find a very similar set of issues. There's that, there's that garbage company. There's a couple of the larger Canadian oil companies. You'll see a Bombardier bond. You'll find, some of these other Canadian issuers, and the reason for that is because there's about 100 bonds on the kind of tear sheet that the dealers who deal with Canadian high yield managers have, and not surprisingly, those 100 bonds kind of show up as big positions in a lot of Canadian high yield portfolios. But if you look at actual, like, the North American credit markets, there's 3,000 issuers in CAD and USD of more than $100 million in debt. So it's a lot bigger world out there. But if you're going to address the whole world of opportunity, you need to have a research system that's set up to look at more than just 100 names you know. And so, I talked about our work with credit sites and our work with independent credit research that gives us, another 95 analysts who are sector specialists that work in there at the side. And that is certainly is something that helps us, look at a much wider range of securities. The next, kind of feature of our return generation plan is to really focus on the strongest risk-adjusted returns. And one of the ways we do this is we use, this whole default probability model system. So imagine you have this number. You have a default probability, it's 1%. And you have another number, it's a yield, and it's, let's say, 10%. Well, that you could kind of compare that yield 10 versus 1. That's 10 to 1, right? And what if you had another bond and it yielded 9%, but its 1 year default probability was 3%? Well, that would be 9 over 3. That would be only 3 times, whereas the first bond would be 10 times. Now, we obviously do a lot of deep fundamental research on the names that are in our portfolio, but this top of our funnel, where we start to take names into the top of the funnel, we'll try to take in the names with the kind of the 10 to 1 yield versus default probability, because we know what the index average is. The index average is something like 3 to 1, and so if we start with that advantage, and then hopefully that'll lead to a stronger return. And then the final thing we do on the returns generation is that in our weekly meeting we take a look at where all the bonds lie in terms of their yield to maturity, which we risk adjust to a kind of risk adjusted yield to maturity, and then within buckets we'll do this as concentration and rebalancing. And it sounds a bit boring, and here's really what happens sometimes is you have a bond will go from 5 years and a day yield term to maturity to 4 years and 360 days, and you don't think it really matters much. But somewhere in this wonderful bond market that we've got now, it means it's out of one large ETF program and maybe into another, and maybe not into any one at all. And so you'll find a bond will be humming along, at least in there at 102, 103, and then suddenly it's 99 or it's 104. It's moved around a bit in a way that's rather unrelated to development of credit risk. And so when we see those opportunities, those will pop up on our screen as either adders or sellers within our own system. And we kind of do this rebalancing trade, and what that delivers over the course of a year, it's kind of a bit of an imprecise. So at this point, some people say, well, Geoff, that all sounds good. Does any of this stuff actually work? And I guess we've just passed our 5-year anniversary of as manager of this fund. I think that the 5-year number for the fund after all fees and costs was something like 7.2%, which was a fair bit higher than the other funds in the high yield category in Canada. So, so far so good. So that's sort of like the game plan in terms of what we do. Now I'm going to do a little bit of credit school, keeping in mind that we don't have an infinite amount of time. So I'm going to just be quick in this next section, and then if you have questions, I've bored Michael to death about this hundreds of times, so he would be a good person to follow up with. But let's talk about, first of all, why you even own junk bonds at all. Why don't you just own investor grade? That's what investors do, right? Well, to give you, a very short, backup, if you actually look at, a 32-year history, for instance, of the corporate credit market, and you take a look at the excess return over treasuries, by ratings band, and you take a look at it from the point of view of including all losses, all bankruptcies, all costs, and how actually, the total return has evolved. Maybe not surprisingly, but you actually do earn a higher return. And so that's obviously why we're involved in this area. Next slide. Now, can we do anything better than just be in wider spread credits or lower rated credits in some portion of the fund? And yes, you can. And this next study kind of shows, which are the factors. You've probably heard about factor investing in equities, growth versus value, et cetera. Well, what are the factors in credit, and how do the different factors perform? So this is actually an interesting study, 17-year study done by the Stern School out of New York, which has the best database. And I would encourage you to actually, if you feel like listening to a podcast, one of my favorite ones I did was with Ed Altman, the creator of the Ed Altman Z-score, who was at the Stern School and has this wonderful database that was probably used in the preparation of this study. But which is a strategy that works best in credit and over the long run? Well, there's these different strategies. Carry, which is actually just choosing the bond with the highest yield. Funnily enough, it actually works, but it only works very marginally better than the average. A little bit better than that is momentum, which is basically choosing the bonds that had the best price momentum for the last 6 months, and that does a bit better. Safety, choosing the bonds with the lowest default probability. Interesting enough, that actually is better than the others, but the highest, with almost slightly greater than 1% higher return than average as a strategy is value. And if you look at the fine print on the note here, value is essentially yield per default probability, right? Or precisely the thing we were just talking about. Yield versus default probability. You can kind of see, you can sort of feel intuitive about why that works, but it is also the strongest factor in credit performance. So that's, one bit of credit school. Now I'll talk about the two big cycles that matter in credit. The cycle that maybe people are not as familiar with is the whole idea of the term premium. I'm just going to give the short explanation of term premium. There's a longer one because for those of you who are mathematically inclined, it is a little bit of a complicated formula, but more or less, it's how much extra yield you get for extending duration. And this is always done off against a government curve. And, this is a, I guess it's a 25, it's a 30-year chart. And basically what's happened is as yields in fixed income and particularly the risk-free rate and government bonds have come down over the last 30 years, actually really 40 years, if you go back, it's even higher back in the 80s. What you'll find is that not only have yields come down, so yields been coming down, but also the term premiums kind of flattened to the extent that once you calculate, the reason this number is negative is not because the long-term yield curve is inverted, but it's because you actually do need mathematically to get some extra yield to compensate yourself for the additional volatility of a long bond. At this stage where we are now, the term premium is negative, which means you're really paying the market to take on duration risk here. And that's not a great situation, is why we don't really have a lot of duration in the portfolio right now. The other cycle that you may probably be more familiar with is the spread of high yield against treasuries, or high yield index spread. This shows the past 5 years of that spread. What you can see is, obviously there was for kind of most of 2018 and 2019, there was kind of a calm period, which obviously got blown all apart with a big spread blowout at the beginning of COVID. And since then, we've kind of recovered, not quite to the low spreads that existed in 18 and 19, but somewhere around the average for what we've seen. And so, that is kind of where we stand. Our intent is to be counter-cyclical against this, and to, basically take on more risk when it's widespread, and maybe be a bit more defensive when the spreads are tight. And I'll just give you a picture of the fund from the point of view of our 3 risk buckets, and what we've done over time. So, for instance, back in 2016, I'll just put you back here for a second. So back in 2016, you had this sort of spike in spreads up to about 900 basis points. So back in February 2016, we took a more kind of constructive positioning with respect to credit risk. We had about 25% in that kind of higher default risk special opportunities bucket. And then we had basically, the liquidity that we needed to maintain our liquidity pledge, but not much more than that. And so we were a little bit more, favorably exposed to risk. Take it to December 2019, which was when spreads were low. What you saw is that, we reduced our exposure to the riskiest parts of the market, and had many more lower default risk securities. And then we had that big conflagration, and over time, what we had done was, through particularly April and May, we became a little bit more risk accepting. And so, when oil was negative $37 a barrel, we were buying, the Chesapeake defaulted term loan at 32 cents in the dollar. And that was a big part of our recovery as it's come back and is now in the market in the mid 70s. And so, there's some things you need to do to take advantage of opportunities. And so that's why you see a more constructive exposure to risk for the fund recently. I'm just checking where I am on time. I've got about 10 minutes left, so I'm going to try not to take too much time. I'm going to just, sometimes I get questions about this lower default risk band, because obviously it includes a whole variety of things. It doesn't just include, government of Canada bonds, but it'll include some investment grade corporate bonds. It'll include some bonds which are kind of like not investment grade, and in that category. And people stop me and say, Geoff, like that's like a junk bond. So you're putting junk bonds in your lowest risk bucket. And I said, well, look, guilty as charged, but there are junk bonds and junk bonds. So let's just explain this for a second. And so these are the 5 largest issuers that we have in that lowest default risk band, which are not investment grade. And I'll just kind of show you an example here. So what these bars represent is the capital stacks of those issuers. So for instance, if I were to buy, let's say, all of the bonds that Twitter, all of the securities that Twitter issued, so the equity and and all the debt, it would cost me roughly $40 billion. But we're obviously sitting there. Our piece of debt is right in the top, 10% of the Twitter capital stack, and you can see that, they have, I guess, roughly $3 billion of debt. They have $7.76 billion of cash. And they're, if you take a look at what their consensus EBITDA forecast is for the year, almost $1 billion, $800 million. Think of what would have to go wrong to imperil our credit position in Twitter. Well, first of all, you have to wipe out about, $35 billion of market cap. Then you have to burn through the cash, and you have to do it quickly because, they could pay off their debt with internally generated cash flow in about 3 or 4 years. So that's, typically you take a look at where we're sitting in those cap structures. typically at the top of a very big capital stack with some good economic fundamentals underneath you. Let's go back to the other page. Okay, I chop those in half. I'm good. Actually, I chop, I guess you take a look at CF Industries, we're in the first lien. I chop that half again, I'm fine. I could probably go half a third time and then I'd be starting to worry. But we have, in those particular bonds, a lot more margin of safety. And so that's why they kind of go in that lowest default risk bucket. Okay, so thank you very much for listening to a lot of theory. Now people just say, what do you own or what's in the box? So this is a kind of a quick look at what's in the box. So 3 different cuts in the fund by business activity, by country of domicile, by risk band. Business activity, I'm not going to go over the different areas in great detail. Suffice it to say, we like to take some different bets. We're not trying to match any kind of index, but we'd like to take some different bets, and those are the bets that we've taken. In terms of country of domicile, there's just more issuers issuing in the United States, and so that's why we have more exposure in the United States. And by risk band, there's those risk bands that we talked about. So, and then, for some people who like to see full detail, we're not going to have much time to go through this, but, like I'm a high yield bond manager, I would never, I know the mischief that you can hide below the top 10 holdings. So I would never buy a fund. They only told me the top 10 holdings. So, what we like to do is we like to display, a kind of a full view of what the fund looks like. And so I'll just orient this to you kind of quickly, but, essentially the size of the boxes represents the proportion of the fund. Along the x-axis, you see the term to maturity. The duration tends to be a bit less than the term to maturity because there's some, call and put rights along the way. The color coding is the risk bands that you've talked about. You'll see one of the things you will see in the fund is something called other. And whenever I see a big other in the financial statements, I often like to ask people about it. So what is in the other? So 3 things. So we do have some securities which are, in that kind of distressed area where we think we can make an interesting amount of money. I talked about Chesapeake, another one that we were involved in recently, a company called Just Energy. That has been converted from a bond to a stock, and we still have a position there of some size. Something else we are involved in is preferred shares. To make a long story short, preferred shares yield versus default risk is very, very strong. The wrapper is a little bit different, and they can sometimes bounce around a bit more than you would like. But we think that one of the best credit opportunities in the market right now is something like Bell Canada preferreds, where Bell Canada bonds yield about 1% and preferreds yield about 5 or 6%, and have really, really strong credit coverage underneath. And then also, again, we'll talk about it a bit later, but closed-end funds, basically bonds that could hold otherwise I could hold the bonds directly in the funds, but held through a closed-end fund structure, they trade at a 15 or greater % discount to net asset value on a daily struck basis, and it's opportunistic for us to buy some closed-end funds and take advantage of that discount to NAV on occasion, and this is one of those occasions. So with that, I think we're coming close to 40. Just one more kind of point on some of those high yield bonds. Now, this is actually another cut of the fund. So some people say, well, I just want to see a cut of the fund not done by your system, but let's see it in terms of how the risk managers look at a high yield bond fund. So here's the PCBF, investment grade bonds and cash, a little bit more than 25%. High yield bonds and loans, about 60%. And you'll see that broken up. So quite a lot of those high yield bonds are actually secured top of the capital structure. And that's very, very important, in terms of preserving capital for the fund. And then, a few closed-end funds, some preferred shares, and some reorg assets as well. A little bit more detail on some of those senior secured debt positions. I'm just going to I'll leave that in case there's questions to kind of explain that. But the whole idea is that some of these bonds of issuers that might have quite a low rating, high enough up in the capital structure, there's a lot of value coverage. Related mandates. So the Pender Corporate Bond Fund, look, it's a $950 million mandate. A couple of sister mandates. One is the Pender Bond Universe Fund. Basically, we take this fund and we just pump up the investment grade portion of it, and we make it, it's kind of like a prohibition brew for places that want a certain amount of investment grade bonds. And then on the balance fund side, the Pender equity team has, there's a fund called the Strategic Growth and Income Fund, where we have the Pender equity team's contribution to about 60, and this bond fund is about 40. A couple of examples of names in the fund. I'm not going to go through these in detail right now, but SunPower has been a great position for the fund, and particularly recently. A relatively new holding is Uber. Uber, kind of interesting company, and we think that the credit, basically, you've got 7 billion debt, 7 billion cash, and $63 billion market cap, and yet the bonds still yield over 6%. Kind of an interesting opportunity. Some things that we do to kind of share our thinking with you. We have a podcast series, and a really interesting part of this is the Profiles in Credit podcast. We talk to some of the people that influence us and are really influential people in credit markets. I recently had a nice chat with David Dodge, the former governor of the Bank of Canada. I mentioned Ed Altman, the guy who created the Altman Z-score, Glenn Reynolds, the founder of Credit Sites, Morley Kahn, Canada's top fixed income trader in the convert bond space, and recently we put one in the can with Francis Donald Manulife about MMT, and that was really interesting talk. So just to wrap up, so what is this animal? If I have to explain it to a client in a 2-minute conversation, what is a Pender Corporate Bond Fund? Well, we're like a value player in corporate credit. What does it mean to be a value player in corporate credit? Well, basically have a disproportionate amount of collateral backing up the positions versus a relatively small amount of debt. The second thing we do is we take this counter-cyclical approach with relation to the two big cycles of credit. One of which is the cycle of the term premium. When there's not a lot of term premium, don't extend a lot of duration. When there is, you can. And the second is the cycle of credit spreads. When credit spreads are wide, be a bit more constructive about credit risk. When credit spreads are tight, be a little bit more cautious about credit risk. And the third thing is, we're sort of nimble and opportunistic. So look, if I was to go work for, Fidelity, they would bring me to a hallway and there would be like 35 offices, and one would be for the 1 to 3 year investment grade guy, and one would be for the 3 to 7 year investment grade guy, and then there would be the energy, oil, high yield bond guy, and there'd be this and that, and there would be 37 different funds. And what Fidelity is telling you is that, well, you're an advisor, you should be following these 37 different parts of the credit market, and when you see the time is right, you should jump from fund 22 to fund 37 or something like that. Our approach is a bit different, but we don't think our advisors are doing that. And what we want to do is we want to monitor those areas ourselves. And then when we think it's attractive in those areas, we try to put weight there. So, nimble and opportunistic in that regard. So maybe a little bit, I think I'm a minute over, Michael, but that's sort of basically an introduction to what we do. And I'd love to have a chance to answer any questions.
Perfect. Thanks, Geoff. That was a great presentation. So yes, what we'll do now, we will go ahead and we will open it up to questions. Again, if you have questions, you can just type it into the Q&A box or use the raise hand feature, and we'll go ahead and get those answered. Okay, so doesn't look like there's any questions today. So again, I appreciate everyone's time today and everyone who is able to join. Geoff, appreciate your time. Great presentation. We'll have a recording of this call as well, so I can get that sent out if you weren't able to attend or had to leave early. Other than that, I hope everyone has a great week, and we will be in contact soon.
If you want to reach out and throw a question through Michael, that's fine. We can send some of those back.
Absolutely. We'll get any questions you have answered. Thanks, Geoff. Thanks, everyone.
Okay.